The crowd doesn't care about your financial model or your projected IRR. It cares about the excitement, the enthusiasm about an opportunity, and about trusting you.
Hello, everyone. Welcome to an episode of Test, Optimize, and Scale with Shawn Levine. I look at Shawn as the authority, the guy who manages publisher relationships, distribution for issuers, for companies that are issuing shares, often leveraging Regulation CF, Regulation Crowdfunding, Regulation A+, Regulation D. Shawn has a deep history in the worlds of capital formation, finance as a whole, understands DC and all of these different ecosystems. So I know I've been looking forward to this conversation. It's something I get asked about continuously and point to folks like Shawn. So Shawn, thanks for taking the time to join the pod here today.
Yeah, absolutely, Jason. Great to be here.
And should mention Shawn is the principal at Iliad Funds and can, speak further, on the advisory side, Iliad Fund Solutions, not just on the publisher activations themselves. But Shawn, I know so much about you, being at these Regulation A+, workshops and conferences and all different types of events with you over the years. Where did it all begin with for you? How did you get involved in this world of digital capital raising?
It was kind of a long and twisty path, at least as far as like where things are now and where they've gotten to. I'm an attorney. I don't practice. I did not like it, and that was never. I just wanted to get. You mentioned DC. I wanted to go to law school because I wanted to get to DC. I liked. I was dumb enough to be excited about policy and politics at a younger, more. I guess naive point in my life, but I did, and that's what I leveraged it for. I got to DC. I did ended up doing political intelligence work for a broker dealer out of New York that I worked for several years. Basically, this was around 2008. Obama had just gotten elected, and all the hedge funds started looking at DC, going, "Oh, something's going to, we don't know what's going to, they had their glory days of like, just DC didn't matter. They were going to do anything. And now whatever it was going to do, it was going to do some stuff. And they needed to know, have an idea what that was. So they knew I was down there like, hey, Shawn, go, you want to talk to these guys anyway, go do it. So I spent several years schmoozing lobbyists and like taking them out to, and if you want, you're going to DC here pretty soon. DC is a pretty solid food town. And so a lot of people don't know that. And nobody knows that better than the lobbyists, because they're the ones usually schmoozing other people and having to pick up the check and knowing where the best food is. And I was a foodie, so I got to mine that very, very well and got really plugged in. Then I got ended up with 4 securities licenses while I was there. Series 7, and then like the research analyst designation. So like all the underlying math for valuation and fundamental analysis and all that stuff. Then ended up over with an oil and gas land brokerage in Houston, writing some newsletters for them for their clients. All their clients were like the wildcatters during the frack boom, like figuring, buying and selling parcels of land. That was their business, and they wanted to stay in front of them. So it was kind of corporate level type communication, industry buzz and stuff like that, and covered capital markets and some other aspects of the business. So it's like got kind of comfortable covering cap markets, at least in one industry. Then things kind of get closer to where we are now. I got reconnected with a good friend of mine on Facebook, and I used to be kind of a Facebook troll, and I'd get on and like, just start arguments and things. But I would do it on weird things because I was an oil and gas nerd. So I would like just start yammering about oil and gas. It probably would have made more sense to be on Twitter. But anyway, I did that. And this guy starts arguing with me that I'm saying the oil price is going to collapse because we're overproducing and everything. And he's like, no, he was wrong, but it wasn't like Facebook wrong. It wasn't like, and so is your mother, it was like he was saying things that were logical arguments that were well thought out. They were just wrong. And so this made me curious. And I'm like, what do you do? What's your, and so he turned out he was one of the top coal and steel analysts at Wood Mackenzie, which is one of the largest natural resource consulting firms on earth.
Right.
And he was kind of ready for a move. And meanwhile, I'd been introduced to this newsletter guy, this financial publishing editor-in-chief at this publishing house. It was pretty good size, and they would sell subscriptions talking about the markets and investment opportunities and things like that. And they were pretty expensive subscriptions. And they were selling these to retail investors, so like non-accredited, not necessarily multimillionaire folks. It turns out this is like this huge thing. And people eat it up. They have millions of subscribers, and at least in the industry as a whole. And so we'd been talking about doing something for a while. So it came together that my friend Matt and I came over, and we're going to do this sort of holistic energy analysis between him, coal, me, oil and gas, how that plugs into steel, and all these other things. And so we came over, but they wanted to sell it to institutional. They wanted to sell it to banks and things like that, which was not their sweet spot. Turned out they didn't really know how to do that, how to sell to institutional. It's a very different, which we can get into, is a very different conversation between high net worth and institutional and hedge funds and things like that, and regular retail investors. And so they didn't really have that patois down, right? So we get over and we can't sell the thing because it wasn't our job and they couldn't do it. So, but in the meantime, we're sitting there and we had built a really interesting model that kind of pinpointed to the quarter when these oil and gas companies, the oil price did collapse, right? I was right. That was part of how we got this going, because it was like, well, Shawn's not totally worthless. He got that one. He made that call. So all these companies are blowing up, and quarter to quarter slow motion car crash is an industry of like 80 public companies, the micro caps and everybody else. And so the model we built was nailing down quarter to quarter. They're going to blow up in Q3 of next year, and then they would. And so one of the copywriters came in one day and like, I know you guys are oil and gas guys. We're doing this launching this new promo about the death of the mall, and how the malls are all closing and the ghost malls and everything, and how this was bad for retail, obviously, and what that, the retail crunch. And they're like, the problem is we don't have a system. We just have this great idea and we know what's happening, but we don't know how to pick, what's going to happen. And they're like, you had that thing. Would that thing work in this over here? And we rebuilt it, and it did. So then they're like, these guys can do whatever. We had them pigeonholed in energy. They're fundamental analysts. We learned technical analysis. We did all this stuff. But it really, I spent about 4.5 years at this newsletter, and I got really, this was really a rude awakening to me to see how people communicate with retail investors about investing. And I came from that institutional background and being very like, totally everything is double and triple checked, and make sure that, and you're not trying to be excitable and doing, it's just the facts, and here's the model underneath it, and go to tab 3 and all that. So I'm just like kind of aghast, like, holy cow, you guys say that stuff? That's amazing. And they're like, yeah, and it works. And that's what, so I still sometimes when I see some of the things that are said, I'm like, wow. But what I came away from that experience with was, holy crap, does that work? That means of communication with that audience is insanely effective. So that was my takeaway from having soaked in that. A lot of people in that industry start out of school and they have an English degree and they get hired as a junior or whatever, and they just stay there. I kind of weaved in and was like, wow, this is something. So toward the end of that 4.5 years, we're at 2019. Crowd started, Jobs Act had been passed for quite a while, but they'd finally gotten a lot of the machinery figured out how it would work. And it was starting to happen and gain some traction, and people were starting to become aware of it right around that time. So these guys were also good at, in addition to kind of selling regular people on ideas, they were also at least our shop, the guy was really forward looking, my buddy that brought us over. And he recognized this is a whole untapped space for us, because all they had done up to that point was like microcap stock picking, very similar, but early stage, high risk, and options trading, stuff like that. That's what was popular at the time. Nobody wrote about this stuff. So we were one of the first ones to launch a newsletter focusing on crowd, Reg A, Reg CF primarily. And some other ones very soon followed over the course of that year. Like we kind of tip of the spear, but other guys, they like chasing each other. And if something works, which did really well, they sold insane numbers of subscriptions for this, proved the demand, was there among their reader base. And then we started getting just word of mouth from some of these issuers who were getting covered. This was in the very early days, and the impact, might have been disproportionate because of that, because the market wasn't flooded with this kind of stuff. But there was some cannabis deal or something. We had a cannabis newsletter, and the company was like gushing and thanking us profusely and all this stuff. And like, oh my God, we raised $18 million over the past 3 weeks. And we were running attribution on it. It's almost everything was because of your recommendation. So, and they didn't pay for this. That's the other sweet. It is ridiculously effective. And if you could get it, it was free because it was earned media. These guys, they make their money from the subscriptions from the retail investor, readership that pays, maybe a couple grand a year sometimes to get access to this content. And so they weren't taking, they just took on, they called it fulfillment. They took on these obligations of, we're going to get you so many recommendations per year. We're objective. We pick the ones we like, what have you. And so if you got it, you could be in sort of a sweet spot where you got, and that's for Reg A. Well, shoot, at the beginning, Reg CF was just $1 million, right? So, and I don't know the timing of when you came into the space, and I don't want to, cast aspersions on some of the early marketer guys, but it was funny because, so I'll fast forward a little bit. I end up leaving there. I see this huge opportunity, right? I'm like, holy cow, crowd is going crazy. It's starting now, and it's here. This is where the action is for crowd. And, I mentioned I'd had the securities licenses. Well, I had connected with a new broker dealer also in 2019. My licenses were going to expire. They do that after a while. And I met these guys, and I thought maybe we'll get into private placements. I didn't know, but I wanted to save them. And I thought there'd be something we could do. So I go to them and I say, look, I just found Sierra Madre. Like, this is crazy. I know most broker dealers don't do crowd stuff. We should figure it out because if we can find any way to leverage or plug into this universe, we'd have a very nice competitive advantage for our clients. And so did that. Went over with broker dealer, and I still have a broker dealer relationship now, and we run some deals. It's not all the time, it's not everything I do, but we can do that, and we're market competitive and all that. But getting over there, and then seeing, all right, if we can get plugged into these channels, it's ridiculous. And that was sort of the value proposition when I came over. Before everybody knew that this was the thing, this is the thing I was going to say. Before everybody knew that, and everybody still doesn't know, we probably wouldn't be talking, that these publishers are there and that they'd still they've had some highs and lows of activity, which maybe we'll get into, maybe we won't. But when you do get a recommendation, still to this day can be very impactful. Up to the $5 million CF, there are a few newsletters that can fill like a $5 million CF around in a couple of days. It does happen still. Yep. But seeing, I lost it again.
Seeing it all happen, seeing it all to come together got you more attention, and more issuers wanted to. Oh,
this is what I was going to say. This time I'm going to say it before I forget. Some of the early marketers, right? So I'm at the broker dealer, so I'm talking to all the ecosystem providers, right? And we're trying to, that's part of the role of the broker dealer is like, we're going to get you all the good, I would refer stuff to you now, and if we need a digital marketer, that kind of thing.
Mm-hmm. Well, and which were you back then?
That's right. That's right. But so I would talk to some of these early entrant digital marketers, and I didn't meet you till a year or two ago, but some of these other guys, and they would say, oh yeah, such and such deal. Yeah. Cause I'm asking for examples because I don't know them. And I'm like, why? Tell me why you're good. I'm like, yeah, such and such deal. Yeah. $1 million. They got maxed out real fast. Yeah. And then this other deal, he rattles off like 3 deals. And then I say, didn't such and such get recommended by this newsletter? And didn't that drive like 98% of the, and then this one did. And then Yeah, they did because they knew about it because they were seeing it. They were the ones seeing the effects of it. But I'm on the other end where it's happening, and so I knew about it, and they knew about it. Not too many other people did at the beginning, but
Sure.
So go ahead.
Yeah, and just to recap a bit here, a lot of information. You started as an attorney. You have your securities license. You were dabbling in the world of DC and saw this opportunity and were writing about oil and gas and seeing success. Being able to predict what was to come, that was showing up in your deals and your picks. You guys eventually created a newsletter after fighting with others online, I'll say in a joking manner. But, Cole and Steele, you're starting to talk with these others, may I say, influencers and building partnerships. You create your own newsletter and determining, hey, these writings go out to high net worth. These are designed for institutions. This is for retail. You're seeing success in a whole spectrum of different verticals. You mentioned the cannabis deal, 18 million in the matter of a few weeks. You're starting to see marketing agencies, portals, other groups in the space kind of overstate what they were doing. And maybe they're involved. Maybe they're talking about that they're featured by this publisher and driving some traffic with ads. But you're firsthand looking at the impact of media. And if we do this thorough analysis and put out this report to an audience of subscribers, and for those who are not familiar, there's these financial publishers that retail high net worth institutions pay for. They pay to receive those emails. And with that research, they then determine what they're going to add to their portfolio. So you're trying to now pick out the right deals, the right partners, and the right things to talk about, and use all of your expertise to be able to get those investors to the right opportunities, the right deal flow.
Yeah. Very, very good. Very good summary. Yes.
Just want to make sure I'm not missing any pieces.
Yeah.
So that puts us to about 2020, 2021, when the industry picked up. What did it look like there at that stage for you?
It's kind of Wild West and land grab, and different names starting to pop up more frequently, and maybe shifting what they do, and and everybody's kind of figuring it out, right? I think we've had three waves in my view of crowd sort of so far, and wave one was, look, here are some rules. Government says, here are some rules. Go do some stuff. You'll figure it out. Here's the rough draft of it. We're not going to tell you exactly, but this is what we think it should look like. You go figure it out. Mm-hmm. Everybody does. Then wave two was sort of and you see this, the proliferation of the funding portals and all the entities that you need in place to do. And then the digital marketers, like, you guys start realizing, hey, this is a new market. We should start looking. Wave two is sort of the tech. And, as you have these specialized funnels that the investors, when they come into a crowd deal, that they have to navigate, because the deals aren't sitting on Schwab or Fidelity. You need the onboarding material to get the investors in a legally compliant fashion. So certain entities came up with their tech stacks to do that. But the people did it for a while, and they're like, okay, well, now we have the tech and it's compliant. But does it really? What about the conversion part of it, right? Like, you don't want something so onerous or clunky or awkward that you're going to lose people through the funnel. And you're also asking a couple of delicate questions in the funnel at the same time a lot of the time. So it's already a little bit of a interesting proposition to get people through this thing. The least you can do is make it as streamlined and efficient and effective as possible. So that was kind of wave two, was optimizing that. You're talking about optimize, that they had to optimize that tech, and the people have made some really good advances on that. And there are some folks talk about, like, 4-click invest. If you've already done it, through their tech before, it's like 4 clicks, you're in, and a couple clicks, whatever. That, I think you would probably say, is pretty darn efficient. That's good.
Yes.
But so third wave is kind of, now we're kind of getting down to brass tacks. And this is when you think about brokers and broker dealers and the funding portals to a lesser degree, that when people thought about stockbrokers in the old sense, or in the sense of private placements and things like that, they're the guys finding the money, right? Mm-hmm. They bring the money to the table. But in this context, the broker dealer and the intermediary is sort of like a compliance toll taker. Like they're getting you through the process so that you don't get in trouble, and they're taking the pound of flesh. But really, I mean, funding portals take more, but either way, it's a much smaller coupon they're clipping than what a broker might get for going and finding a $2 million, hedge fund to drop in, that money to a private placement. But what that's because they're not finding the money. Mm-hmm. And you guys help find the money in the sense that you're creating awareness. You're not soliciting and doing that kind of thing, but the stuff that and that's the problem. The brokers are the only ones really allowed, other than the issuer themselves, to try and sell the security. You guys are creating content for the issuer for them to put out as their content. So that's fine. They can do that because it's them. You're just helping polish up their message, but it's their message, right? But you also, at the same time, have this very interesting whole other category of content, and it is third parties. Mm. And they have big followings. And so this is what kind of got, everybody's finally realizing we're going to build out, there's other things coming along too, like call centers and things like that, other ways to kind of interact with folks who are engaging with expressing interest in these deals. But this is where I kind of started to go, it's good that I can run the deals, but it's hard for us to add that value at the brokerage because there's a lot of risk. If you're a broker and you're doing this, there's a lot of risk associated with it. And they don't have the Rolodex. They do private placements because they have a Rolodex of high net worth folks that it's easy. They know those people. They don't know mom and pop and Joe Sixpack in middle America on their couches to go get somebody to cut $1,000 check. Mm-hmm. They don't have that. Schwab and Fidelity have that, and they don't want anything to do with this space, at least not yet. So there's a big opportunity, a big window. And I started going, I have all these relationships, and I've seen them work really well. The problem is there aren't enough of them, or at least the ones because they never really there are some that do it, but they know that it's kind of a little different regulatorily. It really shouldn't be. It shouldn't be, but there's a sense, there's a perception within that industry that it is. And so some of them have, and the other thing that happens is, when people come in, if you have a newsletter, you can make recommendations left, right, and center if you're talking about microcaps and options and stuff like that, because people get in and then you get them out. And therefore, that pool of capital that they're sitting on and deploying per your recommendation is it's kind of recyclable in a sense. Like if the recommendation works, you make 20%, 30, 50%. Doesn't, you lose 20%. Hopefully they got you out. They see that it's turning against them and they say, get the money, get what you have out. So you just keep playing with that pool. And, sometimes you get higher and hopefully you get frequently higher, but either way, you can redeploy. So you can make recommendations in a decent pace. So this has also been a problem. There's, maybe a half dozen, maybe really probably less, 3 or 4 newsletters that really focus on Reg CF and Reg A, but also some of them have throttled back the rate at which they'll make a recommendation because this money goes in for years, oftentimes, and it's illiquid. In CF, it's locked up for a year. And even then, it can be tricky to find a buyer, even when the lockup ends, if you want to do that. So they risk kind of burnout. So spreading the coverage through more entities would be a positive for the space, for the participants, et cetera, and for the communities, because you're finding, every community kind of finds their person that they like to hear about this space and they go with them, but they're maybe not hitting everybody, and they preserve more capital that way. But the whole point of this is, it is, you might say, well, Shawn, why are these guys, they're not a brokerage. Why are they? How can they do that? How can they make recommendations? And there is a specific carve out. What they're doing is essentially very, very similar. It would be being an investment advisor. It would be what the rules would consider being an investment advisor, which is similar to, but different than a broker dealer. It's almost the flip side of it. The broker dealer's client is the issuer. Their job is sell their stock. The investment advisor's client is the investor and give them good investment, opportunities. But two sides of the same coin, kind of. But they're also pretty heavily regulated. And there is a carve out in the definitional rules for what defines an investment advisor for this sort of activity. They call it the publisher's exemption. It's
Right.
my hat on. It's an exclusion from the definition. No, whatever. It's an out. And so these guys follow that, and they can do what they do. And a lot of it has to do with not giving individualized investment advice, have a direct relationship with the readers and things like that. Avoid that stuff and do a couple of other things, and you're okay.
Sure.
So what I'm doing now through Iliad, and I kind of danced around the edges of it more. Originally, it was just sort of like trying to be kind of a publicist for crowd issuers and connect them up with newsletters. And now I've expanded that in a couple of ways. I can come in and help create content myself, either for them to use through their own channels, or I also started a newsletter myself recently called Investment X. It is, but I'm being extra careful because I have the brokerage relationship and everything else. So it is free for readers. I'm getting engaged, and I disclose that I'm engaged by these issuers, but they just want to tell their stories and they need more outlets to do it. So I'm helping them find audiences and helping tell their stories. But that way I'm not taking any money from the readers. And it's something that as the issuers, as I'm helping the issuers tell their story, they're kind of helping me grow my community. There's a nice interplay there. At the same time, that's very early stage right now, but it does exist and it's growing, and we've got content going out, and I've got a client that we're going to start ramping pretty soon, next few months. The other thing that I think is really interesting is those newsletters they get their subscribers from somewhere. And that somewhere there are these folks out there, it's niche industry within niche industry, like nesting doll of niche stuff. But these guys, they build lists. They build lists of names. They're usually not there. Sometimes newsletters do have employees who do this, but a lot of these guys are independent. They go out and they build lists of likely target consumers for that kind of content. And when the newsletters they'll cross promote between each other and stuff like that. But when they want to get new blood into their reader base, they go to these guys and they figure out the economics. And it's similar to how you might run traffic on social media. There's, CPX metrics that are involved and things like that. And the difference is this is so almost deep webby kind of stuff. Like nobody knows let alone that these people even exist, let alone who they are. But because of my tie-ins to that newsletter industry for so long, I was like, I need to cultivate those relationships because there aren't enough newsletters to write about this stuff organically. The audiences like it. We know the audiences like it, and that's where they're getting the audiences. So if I can help sort of take an issuer to the wholesale level, if you will, get them directly plugged into those distribution channels that come up with the lead list for the subscribers to sell the newsletters to, which again can cost $2,000 a year. If that's your crowd investment level, if that's an average $2,000 per investor, that'd be pretty good, right? That ain't bad. Absolutely.
And that $2,000 a year that a retail investor's paying to receive this content, they want to receive value from. So they're going to act on a good amount of those recommendations. And there's tiers in these newsletters. So some of them are free at first, and for the real good stuff, you have to pay here, and then multiple tiers above that. And it's been common. It's commonality among many of the top issuers to date. And I've seen publishers come and go. I've seen lists get burnt out over times. As you said, as a retail investor puts in their own hard-earned money or portion of their portfolio, however organized they are, they have to wait. And not just that lockup period, but there has to be a liquidity event, which there is not for many of the Reg CF and Regulation A+ issuers to date. Others have gone public. One of our clients just went public in the past month. There are more exits that are occurring, more investor success stories, which I believe will bring more interest into the space. And some of the groups you mentioned, the Schwab's Fidelity, they're already getting involved, but I think a lot more companies are going to want to get into this fold, I think it is going to be looked at as the new way to raise seed, to raise Series A, to remove some of those titles, to be able to have a whole new model 5-10 years out. But it's these newsletters that issuers strive for. There's paid options, and like you said, then the investors are receiving the content for free. And I know there's some very strict rules around that. There's options where you're one of 100, one of 1,000 issuers that are picked to that paid subscriber audience. But it is so impactful when it happens because it carries that social proof, that third-party validation. I always say people don't believe what they see on the internet. So the more times they hear the same recommendations, but from the more sources, the more they believe it. And to hear that's what's in the background of the list builders. And I've heard different things. I'm actually learning a bit as you're talking about it here. Even a little surprised you're sharing some of it. Not that it's a secret, but you're talking about people that don't want to be known. But I know for our audience,
okay. I've got a little bit of a moat here because it's so niche, and you can't just Google up like ChatGPT is not going to give you a list of 10 names of groups that do this stuff. It doesn't know. It's not out there. Like when I said deep web, I'm kind of kidding. Dark web, I'm kind of kidding, but they're not out there. It's not publicly available. It's not readily available information. You can't just Google it up. It's very relationship driven. These people can be very mercurial, and they don't always like being out. They got a good thing going. They don't want to mess it up. They know what works. They would like to have a new vertical of a whole new universe of customers who would love to pay them to do what they're already doing. But other than that, they like staying off the radar. So somebody would have to spend several years doing what I did or hire me to get plugged in that way. So it's fine. Mm-hmm. And I want people to know about it, because if they don't, they're not going to see the value of what I'm doing. So
sure. And I was mentioning the list building and how we apply that for custom audience targeting for advertising has made all the difference. I mean, we'll outperform portals advertising teams, in-house marketing teams, other agencies because of that audience. Outstanding levels of results in comparison to industry averages for cost per acquisition of each investor, return on ad spend. Founders will lean into that and buy a lot more traffic because they know the return that they're going to get. But it's all based on that appetite, that interest, the in-market audiences that you're mentioning. Right. For founders that are listening in, and we want to get to the test optimized scale questions in a few here, but what are some of the do's and don'ts? What are some of the things that they should be taken into account if they want to get featured by publishers? Because I believe there's this misconception that it's really easy. Hey, I'm going to put up a Reg CF campaign. I could raise up to $5 million at this point. It went from 1.07 to 5 in March 2021, or 75 on a Regulation A. I'm going to put up this deal, and we're going to get some publishers to talk about us and cap out the whole thing in a few months. When I study the statistics in the industry, I'll go on King's Crowd every week. That's simply not the case. The top 10% move, the bottom 50% of issuers raise next to nothing. Yeah. What are the best approaches to get covered by publishers?
So a big part of it is relationship. And it is either people like me or other people. There are a few other folks out there who have, some of those relationships, and some of the portals, and some of you guys, might know one or two of them as well. And that's great. And if you can, but it's really beneficial to have some kind of an in, because it's almost like, the hiring process when, you just send in your resume totally cold to, 1,000 places, maybe you get 10 callbacks. It's just very hard to crack through the cold. A few of them have like, hey, send us your deck. Here's a place on our site, you can upload it. And one guy, I guess they finally got sick of everybody driving him crazy and just like, here, just send it. But again, that's good for them. That doesn't help. That makes it harder for you, because now you didn't get to anybody. You just shoved it in the in a file in a Dropbox and hope that somebody looks at it. It's nice that they developed that. The one shop that did that developed that process, because it's more egalitarian and good. You're at least making yourself accessible in some way to everybody, but it just makes it that much harder if that really is the only determinative factors that you went through that process. It is still very much, you're going to get a very nice shot in the arm if there's somebody human to tell your story that can get to that, whether it's a gateway analyst or the face of the public, whatever it is, somewhere in that machine, we can say, this is a really cool story. And that actually is a second point. And I'm thinking about, I'll be talking about this somewhere in the test optimized scale as well, but you need a hook. You need something exciting about what you're doing. And that every company, like some companies just shouldn't do crowd. And that's a bigger question as well. Cause like it's just when I'm not going to say exactly what that is, because there are exceptions. But the bottom line is, the more, let's say, consumer facing your business is, that's a plus. That's at least a check, because it should be relatable. And I'm answering a slightly different question, but it's the same answer, because when these guys are thinking about what they want to recommend, yeah, they care about the underlying fundamentals and the potential, but part of the reason that they communicate so well with retail investors is that they themselves oftentimes have the mentality of a retail investor as well. Yes. And they want to be excited about a company and sold on the idea of a company and what it might do as well. So it's more important than anything to have the story, a hook, something exciting. If you have somebody on your management team who's really charismatic and can go on, do podcasts, and somebody who's engaging and likes telling their story and whatever, have that person be the face, even if it's not the CEO. Like, if they're going to be in your little 5-minute video clip that's on, whatever funding portal, have it be that person, because that matters.
Yeah. And I find, a lot of founders are not as extroverted as others. They don't want to be in front of camera. They don't want to, publish, even if someone's writing on their behalf, and they're putting out articles every week. I think those are great recommendations. And I like to say the most proactive founders have the most successful raises as a whole. We're getting to we were brushing on the test optimized scale questions here. And for new listeners, for new viewers, basically want to package actionable insights that you can test out for yourself. And I look at marketing, entrepreneurship, growth as, a series of tests that need to be validated before you ramp them up. Shawn, you were, getting on it there. I hope, not asking the questions in too repetitive a fashion, but what could viewers do to test out towards their own growth and around your area of expertise, around research, analysis, talking about a deal and getting distribution?
Okay. I'll do a little bit about on some of these when it's relevant. I'll try to do a little bit on just like your business more broadly, like trying to grow that part of things as well, just general advice, and then some crowd stuff.
Please.
For business, as far as growing your business and thinking about your business and testing, and this is just through my own experience of this journey that I was telling you about and some of the things that I've gone through and trying to figure out the best approaches for what I was doing. Try and meet your customers where they are. Try and figure out what, their pain points. If you're trying to do something as far as your business and it's not working, it's not resonating, it's not the market's fault. A lot of times and as you talk to more and more prospects, a lot of times they will tell you, you'll whether they explicitly stop the conversation and say, this is my problem, fix my problem. As you talk to people and get to know them, it's going to come up, things that are causing them problems. And if you can solve any of that in what you're trying to do, then that's going to give you a nice leg up. Like I said, my clients have been asking for help finding investors for years, begging for it. And within the industry, nobody's really fixing the problem. Again, other than the digital marketing solution is the answer right now. That's what people do. Or they have a big community internally that they can hit, and they do that in both, and maybe that or you're lucky to get in with one of the few newsletter options. But nobody was really trying to attack it, at least at scale or through the channels that I was positioned in anyway. So that's what I did, and it's resonating. For crowd, again, I mentioned the hooks that you should have one or more. You shouldn't do it. If your business is something complex, it doesn't mean a hook doesn't exist. It might not, but either way, if you want to do this, you identify one or more, or you're just throwing your money away. And touched on this slightly earlier. Also, don't think about impressing the crowd the same way that you would court a venture capitalist, or that, if you tried to do private placement type raise. The crowd doesn't care about your financial model or your projected IRR. It cares about the excitement, the enthusiasm about an opportunity, and about trusting you. That's, to me, as far as that's the 80 out of the 80-20. That's the Pareto is excitement, enthusiasm, trust. That's, if you can hit those, then, and you want it. I mean, you still need all that stuff. You still need the models and everything. And a few people will look at them, and you'll be very happy that you had it for that 20%. But in retail land,
excitement, enthusiasm, trust. The crowd does not care merely about your model and financials. I want to quote you on that. I say it in different ways, and it is so true. They're looking for that line around the block. And what you do largely creates that, and the numbers that follow, the volumes of investors. But what if that's not happening? What if they do some content on their own, they find some distribution channels, we use the term, financial email newsletter again, they get covered somewhere, maybe they pay for one that's lower tier, and they don't see investments. You have people calling every day, I need investors, and I can imagine what those calls consist of. Yeah. What if it's not happening? How do you pivot? How do you optimize and manage to a point of effectiveness?
Look, some of this starts getting into your expertise, right? And like you guys are kings of the A/B testing content, and again, the hooks, the ideas. Try and come up with a few, and then see what those conversions are like when you run one idea versus another. And if neither one of them is doing very well, come up with another one. Or again, you might have a problem. But when you have creative people who are there to tell stories, either visually in short, punchy mediums like the way that you guys often do it, or the longer form, storytelling that we do. Those people should be able to help you think about, outside the box, your story. Well, what about, and tell that story. If you've been working with people for a while and you haven't revisited again, maybe sit people down in a session and tell your story, and have those service providers and partners just kind of sit there and think while you're telling it, and try and look at it with fresh eyes. Maybe bring in some mid-level reps or people that you haven't brought into the conversation, switch some people around and have them listen. Because it's amazing what ideas will jump out when you know about communication, regardless of what channels you're using. It's amazing what things might jump out at us that would never occur to them to be like a focal point or the focal point. They might be emphasizing completely the wrong stuff. So
sure. When you're talking about something all the time, you may think it's great, and you take it to an outside party and they have a list of notes for you. I believe in closed loop communications, test out some investors, do investor surveys, get that feedback with a smaller pool of recipients before taking it to larger stages.
Test it on your, you're kind of talking about a midpoint discussion, right? You've done some work, you've gotten something going. So you've got, if you had an existing community before you started, which would be nice if you did, but you don't always. But if you have anybody, friends and family, even like your inner circle of people who care about what you're trying to do and are your friends enough to give you some honest feedback, and then whoever you have brought into your orbit already, I mean, there's nothing stopping you from going and trying to get them to invest more. So hit A/B test on the people you already have, and you might be able to do that a lot more cheaply. Then go and see what works better in that universe before you go throwing money fresh out into the void when you don't know how it's going to, at least try and narrow it down. That might not be too shabby an idea, as well.
And if they're not investing, like you said, there's a bigger issue you need to look at, even if it's just the messaging and the hook itself. And I'll see founders who are hesitant. They don't want to share. It could be a failure. And I think there's something there that needs to be explored as well, because you need that warm audience to show up. Our friend Manoj at Public Yield Capital says, if a founder's mom isn't going to invest in them,
He said,
why would he? And I've heard it said in different ways, but it creates question marks if you get to an offering page and there's 12 grand raised, where the same deal with, $2 million and $12,000 raised looks a lot more appetizing.
Yeah, that's right. To your so I was also going to say something about, because a lot of your listeners might be they might be up in the air on whether, or maybe they want to go crowd, maybe they're trying venture, maybe they want to do both. Maybe they're just, I don't care where it comes from, I'm trying every option I have. When this ties into your comment about saying something delicate about, admitting a failure or a loss or something, and it not wanting to do that. And so when you're talking to institutional folks, if you're trying to do that route, and this is an optimization point too, when you talk to enough folks, you're going to start to figure out where you're losing people. There will be trends. People will either bring things up explicitly to you repeatedly, or you will see the conversation start to go sideways. The light of interest will go out of their eye at a certain point, and you will see that, happen semi-consistently in certain areas. Maybe it's your valuation. Maybe you need to juice your team a little bit, get some big name, former semi-retired somebody, and work on those, figure that out and go, that's another optimization point from the actual fundamental analysis standpoint. Those are things you can do. But it's funny. So your point about admitting something, right? Let me think about how to delicately frame all this, but I was doing work. I was doing a research report I actually do that for one of the newsletters I have a relationship with that I've worked with for years, off and on. If I don't have a potential client in front of them myself, they'll have me write reports for them and about companies. And so I'm talking to this founder, and he's talking about, I noticed that they had a Reg A filed that was very high valuation relative to what they were currently trying to do. And it said in their material, it tried to address it with like a one line of like something about financial filing requirements or something. So but they pulled it. They withdrew the thing. They didn't it was just like it wasn't jiving. And it was an early stage enough company where I was kind of up in the air on them as to what I thought about them. It was one of these, like, there's great potential if this works, but you're too early for me to know if it's going. And this is like betting on the horse, not the betting on the jockey, not the horse kind of stuff. Like, I'm like, sure. That's, when it's super early, you've got them and you've got what they tell you. And that's kind of all you have oftentimes. And so I'm on the fence and I see that and I started talking to him about it. And he said, yeah, no, he's like, you're right to ask that. I pulled it. And he's like, I was not the head, I wasn't the main, again, trying to be, I wasn't in charge of he was with the company when that had all happened, but he wasn't the main guy. And as soon as he got in and took it over, he had never been really comfortable with where that valuation had been based upon the stage they were at. And he's like, it's get your mom in, it's Manuja's thing. Like I don't want to sell something that's insanely overpriced relative to where we're at. It doesn't mean we're not going to be there. And he's like, I went in and I just berated everybody on the management because they were all like, why wouldn't we be? Of course we should be 100, 150, whatever they were. And when he told me that totally locked me in on any questions of, at least as long as he was in charge. So it had to, it was a confession. It wasn't something he was comfortable talking about. It wasn't a great laurel wreath in the company's, but it happened. And his answer ended up being the key thing in his whole story that locked me in as a believer. Say, now I had reservations. I was going to write this report in a much more guarded way and hedge. And I actually tell the story in the report. And I'm like, I am not worried. They may fail because it's an early stage company and it isn't in the market yet and everything else. But it's not going to be, I am confident that you're not going to lose your money in this investment because of mismanagement, malfeasance, any of those things that sometimes are a risk at this stage, he totally, set everything on a good, positive track for me by telling me that. So
feature the flaw, then feature the function, but lead with that. I've heard different sayings along those lines. Being able to say, hey, this is what we were doing before, we had to change up, here are the learnings, I think goes a long way. Once you're able to see success, Shawn, what have been some of the key access points to scale? Any tips, any examples? Company hits $1 million, $2 million, they need to get to 5, they need to get to 75. What are the best approaches to scale?
Yeah. So one thing, say you are seeing some good success with your initial tracks approaches you've taken. Very likely, and maybe not with a wizard like you at the helm, maybe this isn't a problem. But in a lot of situations, if you're hitting the same audiences the same way, even if it was resonating really well at first, you're going to start to hit a point of diminishing returns just because of saturation. You're going to have hit everybody. You guys have a finite universe to hit until we change the path or the plan or the audience or what have you, where you will have told the story and maybe you've told it 3 or 4 different ways to that audience. And it could be a big audience, but after a while, the low hanging fruit people will have come in. Mm-hmm. And so then the ROAS multiple starts to get compressed and you start to go, what do we do? You got to be adaptive. I had a Reg A client at the brokerage who raised over $70 million. So in the max is 75. So they got pretty darn close. It took them a few years to do it. So not exactly that, but they raised quite a bit. Most crowd issuers don't raise that much. His philosophy was, I don't worry about where the money's going to come from. And what he was saying was, he didn't obsess about or fall in love with any one particular path to finding investors. He was willing to try just about anything. Whatever worked got more attention until it stopped working, and then he tried other things. And through the whole process, he just worked to get himself out there in the public eye as often as he could, get as many touches as he could, and try lots and lots of different approaches over time as they presented themselves. And that doesn't mean dumping everything into that new option, but, do a little testing and see how it goes. And if it's working, lean into it. And I think that's a decent way to think about it.
Mm-hmm. More tests to be able to scale. Be careful in terms of audience response. If you're doing many activations or getting a lot of write-ups from one partner, one distribution channel as a whole, even the ad spends, we can't go too high on some of these channels without jeopardizing performance. So always have the next tests set up. I want to emphasize to the audience, Shawn's worked with many of the top issuers to date, and this is a privilege for me, Shawn, to be able to hear more of the inner workings. Normally talking about campaigns or conferences or whatever it may be with you. So to be able to spend some time here and go further, in depth. I'm going to be quoting you as we begin to wrap up. First of all, I want to thank you for taking the time to do this. And what are some final thoughts you want to leave the audience with today? And where are the best places for them to go to learn more?
So I guess, first of all, honor's all mine, Jason. It's funny that it took us a while to meet each other, really, we've both been kind of in this space for a little bit. As soon as I did, and as soon as we started talking, I'm like, no, that's one of the good guys. And once I learned more about your business and how you do what you do, it's just second to none. So, your insights and thoughts on these markets are, if I get a podcast going, you'll be on. We'll interview on the newsletter at some point. But I'd say, so I guess final thoughts, maybe some of what we've built toward over the last couple discussion points, it's that differentiation and trying other things, right? I think this is where, for your audience who might hopefully is already working with you, if they're trying to do this kind of activity, they should be. Can't stress that enough. A lot of other marketers in the space, Jason's second to none. But this is where I might come into play, because that diversification approach, right? Targeting newsletter subscribers with long form storytelling through email and text messaging, that is dramatically different approach than running, short visual punchy content through social media, which is more, I want to generalize about what you do, but more in your wheelhouse. And so as a result of that, my audiences and approach, or the newsletter industry's audiences and approach, can be extremely complementary. If they're not necessarily two competing things. If you've got the budget, you should do both at one point or another, or maybe you start in one and move over to the other, and it really depends what kind of company you are and the story you're trying to tell, which go first. But if you have to that point, you have some success in one and starting to tail off, go look at the other one, because you're going to find totally different audiences. Or if not, so obviously people that subscribe to newsletters have Facebook accounts too, but maybe they don't maybe they don't respond in that way to that kind of content. Maybe this is this is what gets them to engage. So contact, if you want to get a sense of what I'm about on the newsletter side, just in terms of like regular touch points, sign up for InvestmentX. It's joininvestmentx.com, and it's free. So by all means, go over there and pop your name in. If you want to talk shop, you can find me on LinkedIn. I got the best. I've been on there long enough. I'm gray. I got / Shawn Levine. So SEANLEVINE, all one word after the / on LinkedIn. Or you can email me at Shawn@joininvestmentx.com.
And highly recommend that you do. That's a very warm offer there, Shawn, to be able to give your email address and take on those types of conversations. So definitely would take Shawn up on that offer and be looking for deals yourself. Joininvestmentx.com. Going to be getting out to our team, so you'll see a few more joins there as well, Shawn. But thank you again. This has been a pleasure, and really glad we got to do this here today.
Absolutely. Thanks again for having me.
Awesome, Shawn. Thanks, everybody. We will see you next time. Take care.